In today's policy meeting, the Federal Reserve adhered to expectations by maintaining unchanged interest rates, thereby keeping the federal funds rate's target range at 5.25 to 5.50%. This decision, following the conclusion of the two-day meeting on Wednesday, is seen by many as marking the potential end of the central bank's rate hike cycle. The announcement not only reflects the culmination of efforts to combat the most intense inflation in 4 decades, but also hints at a forthcoming shift toward rate cuts in the coming year. Federal Reserve Chair Jerome Powell stated during the press conference,
"We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective."
Despite Wall Street's expectations for more aggressive rate cuts in 2024, Federal Reserve officials project a tighter monetary policy, with a forecasted federal funds rate of 4.6% by the end of the year. This is seen as a potential conclusion to the central bank's aggressive rate hiking cycle aimed at curbing inflation. The Fed's recent decision to maintain its benchmark rate reflects a third consecutive pause, with forecasts suggesting a possible shift to rate cuts in early 2024 amid cooling inflation and a slower job market.